Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to talk about what's going on in the economy. Not that I'm an economist or anything, but mostly we're probably not going to talk about that, but it will eventually turn into that type of talk after we talk about the earnings that the big banks had here in Canada. BMO was the last one to report, so we'll probably talk about what I guess the overall just bank industry is planning on doing in the time to come. And yeah, we'll just talk about that, what their predictions are, and what kind of correlation we can have with what we can expect ourselves as investors, as people trying to survive whatever's going on in this world right now financially. And so if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. So as you can see here, the portfolio today in the tax-free savings account is closing out on Tuesday at $13,525.79. Obviously, we can see that we are down $132.62, down 0.97% for the 1 week, down $449.46. That's down 3.22%. For the 1 month, down $110.99, down 0.81%. Down $555.50 for 3 months, down 3.94%. For the 1 year, we're down $28.40, down 0.21%. And for the all, we are still up $1,144.92, up 9.25%. You can see it's just a red day across the board. We have $21 available in cash for trade and $100 going in to be traded on Friday. So that's pretty much it for the portfolio, but let's talk about what's going on. So BMO was the last to release their earnings, and they did not beat expectations. We'll just bring up BMO on the screen here because it is a stock that we own, and them and a few others did not meet the expectations of analysts, which is fine because it doesn't really dictate how good or valuable a stock may be, but it gives you an idea of what is going on. Now, BMO is in the middle of an acquisition with another company, so that played a part in that. Just like how we saw CIBC, who did an acquisition with Costco for their MasterCard. It does play a factor, but it has the potential to create growth within the company. So even though these are established companies, for them to have acquisitions is actually quite attractive in a sense if it's the right move to increase profitability, to promote growth in the company, and so on and so forth. So what is it between all these banks that are kind of an indication of what to expect in the oncoming maybe year, 2 years, few months, so on and so forth? What do they see that we could probably use in our planning when it comes to expecting the worst to happen in the economy? And the trend that's happening between all banks, especially the big five, is that they're putting more capital aside for any sort of bad loans that might occur during the time period of where the Bank of Canada is increasing interest rates. So they are increasing that reserve, just like they did, not quite similar, but they are putting a little bit extra capital away for those bad loans, just like we had seen more drastically in the 2020 era, there in 2021-ish era. And I think what they're seeing is that with the way that rates are going, we have a lot of things going on. People are not able to service their debts, mortgages. Whoever was able to renew maybe 5 years ago, because traditionally a 5-year fixed term is a very popular term for homeowners. And now that the interest rates for a 5-year fixed or any kind of mortgage rate is pretty close to that 5%. Now, it might not seem like a big deal. However, I think in the last video I talked about for variable rate mortgages, there's this thing called a trigger rate. The people that are in a fixed 5-year or coming up to renewal around this season and probably early on next season, these people are going to be walking in from an interest rate of 1.92% right up to 5.4 or something like that. And that's a big jump. How big of a jump? Well, if the average payment or the average mortgage payment is about $1,200, and you walk into, and that's like at 2%, let's say, and it goes up to 5.5%, you're looking at almost probably not public math, but just math in my head. Somehow I'm pulling numbers out of somewhere. Correct me if I'm wrong. But that mortgage payment will jump from $1,200 right up to probably $1,600. Now, that's scary for a lot of homeowners, because sometimes I think a lot of people are living pretty tight when it comes to their finances. And so let this be kind of an indicator for people who are investing, people who are trying just to make sure that they're preparing for the storm that's brewing up ahead, when it comes to the economy, that if the big five are putting more capital away in reserves just in case for bad loans, shouldn't we use that as a sign to maybe put a bit more capital away for ourselves? Because if they're doing it in a way that they know something bad, like bad loans is going to happen, these mortgage payments, someone's going to default at some point, and they got to be able to pay for that. And so it should be an indicator for us to maybe look at that as a sign to maybe put some money away, maybe go back and look at our financials and really plan for the worst. And the thing is, even in capital markets, all the capital markets profits were down. Trading was down. So wealth management profits were a bit down. And that's because we're probably seeing a lot of investors maybe holding back. As we know, a lot of times we are like, buy the dip. I haven't heard that one in a while. This is the perfect time, and so on and so forth. Now, this is not financial advice, but if they're pulling back and we're seeing it in bank earnings, then maybe we should use that as maybe a catalyst to maybe pull back a little bit, just a little, not a lot, just a little, and prepare for what they are expecting. Because I've heard a lot of talk around Bank of Canada maybe not increasing interest rates, but as you can see on the third day here of trading, 3 days in a row, we've seen the market drop, 300 points in a day, 150 points in a day, to the point where we're pretty much negative for the year, as you saw in the portfolio. Now, my portfolio is not a great example of that. We typically go to the indices like the S&P 500, the TSX, and so on and so forth, as kind of lagging indicators on what's going on. Now, Jerome Powell, the guy in the States, Federal Reserve guy, is talking about increasing interest rates. Canada, for some reason, there's this rumor, this info that's going out about that in September they're not planning on increasing interest rates. Now, I'm not an economist, but I don't think that would make sense. We're still in a period where inflation is rampant. We are noticing cost of living is going up, and it's not good in that sense. Now, like I said, I'm not a professional, but even though there's talk of that, I highly, highly doubt it with the way that the things are going and the way that we've seen them play out. Now, the market always puts that into factor. The market is smarter than us. It prices in these things. So if it's happening now, then maybe, just maybe, it's telling us what might happen in the next 6 months to a year. Now, sure, raising interest rates has brought the housing. Now let's talk about housing. Housing, on average across Canada, the housing price down about 20%, but the interest rate is up. So for all those people who are trying to get into home ownership, it's still difficult because you have to qualify. Don't quote me on this, but you have to qualify at the qualifying rate plus 2% for the stress test in Canada. And so even though housing has dropped 20% across Canada, interest rates are high, which in turn just leaves us in the same position for people who are looking at potential home ownership. Now, the thing to put into factor is understand that every time 25 basis points is increased on the prime rate in Bank of Canada, it literally knocks out about, I think it's about 25 to 50,000 potential home buyers and makes them renters without even a blink of an eye, right? And now we're seeing probably people that are going to be re-signing or renewing a mortgage are now being forced to sell because they can't financially afford it. And then they are forced to be renters. And so we are in this weird vicious cycle. And so I guess what I'm trying to get across is, with earnings from the banks, we are seeing what they're doing. Shouldn't we take some of their strategies and maybe apply to our own lives, where let's maybe increase the cash reserves that we have on hand? Let's cut back maybe on the investing, because eventually you can't keep buying the dip. Cannot. It's feasibly and financially not possible for some people because they've actually just deployed all their cash. And so maybe it's time to like kind of just step back a little bit, reassess, and re-strategize what we got to do for the next 6 to 12 months, maybe even longer than that. And so that's pretty much it for the video, guys. I have nothing else to say, but just really taking a factor of what you're seeing in there and maybe re-strategizing, because there is a storm brewing. I don't know what it is. I don't want to sound like a conspiracy theorist. I don't know how to say it, but I'm not. I'm just looking at the data that's provided, using that data, reassessing and re-strategizing. I know I will continue to do my $100 a week just because I can do that. But I am putting more aside when it comes to capital for other things. Reducing your debt is also a great idea if you can, to free up that cash flow. Because if interest rates go up, it does affect you, and it affects a lot of people, even though it doesn't seem like it, like the people who are paying the lower interest rate. But I already talked about that. So other than that, guys, enjoy your week. Thanks for watching. Don't forget to leave a like and subscribe, and we'll definitely see you guys in the next one when I give you the dividend payments for the month of August in the next video. And then we're going right into September. We're going right into the fall. So other than that, guys, have a great week. Bye.